Hello, this is Financial Markets Language with Blake. Today is March 15th. We're going to be going over the financial news that occurred today in addition to the last week that we were unable to cover. Definitely some big topics today. First off, starting with the collapse of SVB, Silicon Valley Bank, in addition to Signature Bank. SVB Bank being, SVB, the banks are included, being the 16th largest bank in the U.S., completely went underwater, and the federal government ended up bailing out this bank, not just to the $250,000 that's required by FDIC insurance on every individual account, but they bailed up these banks to the full amount of every account that was outstanding. Because take in mind, if they just bailed out the $250,000 that's required by FDIC law, you would still have these banks with 92% of their deposits uncovered, aka 92% of the total funds or assets under management by the bank would have been completely lost to this bankruptcy. And obviously these banks are small business banks that primarily deal with businesses, small to even some larger ones, such as Roku, Roblox, in addition to many other Silicon Valley startups that were able to blow up. And in the Silicon Valley mindset, a lot of these companies are funded with VC, venture capital, meaning that originally some investor gives these banks the starting capital to start their banks up, and then from there they have runway to where they can be cash flow negative for a period of months to years before they're expected to make a profit. So they essentially had their entire running capital, many companies, in this bank. So that's why 92% of the funds were above the limit, just because running a business requires typically a lot more than $250K if you're talking about software engineer salaries, commercial leases, where obviously to an individual $250,000 is a considerable amount of money, but to a business they could easily blow through that very quickly, which would make sense why they would need so much money in these accounts, and why the disappearance of that money would essentially mean instant bankruptcy unless they had another round of funding, considering that most of these companies were cash flow negative, meaning that every month their amount of expenses wildly, or in most cases wildly, and in some cases barely, were more than they were bringing in that same month. So without that money, they essentially had no business, and they would no longer be able to meet payroll, no longer be able to pay their commercial lease, no longer be able to pay their other business expenses, and would hence go over. Signature Bank had a similar function. Theirs was more of just a run on their bank, where just the amount of deposits wildly, or the amount of withdrawals wildly outpaced the amount of deposits in a short period of time, and due to the relationship to SVB caused a lot more uncertainty. Take in mind, this just broad stream panic definitely went well beyond these two banks. You saw First Republic Bank going down like over 75% in a matter of 2 days due to their strong connections. A lot of people thought they were going to be a similar case to Signature Bank. And even the big banks, while they're much heavily more collateralized than SVB or a lot of local banks, you just saw broad market panic among the banking sector, especially when Signature Bank went under. They got closed before they were underwater, and it was more or less discussed that it was because of just broad market uncertainty within this company, and that's what caused a lot of people to have a panic and to run away from these banks, causing the deposits to no longer be able to withhold the amount of withdrawals. Because in the banking sector they use a term called fractional reserve lending, where depending on the federal regulations, they lend out considerably more money than they have actually in the cash that they can give out if withdrawals all of a sudden spiked. Typically it's around 10%, but obviously you could look at each individual bank and be able to tell that percentage. But without doing this, it would be much harder for banks to make profits if they had to keep their full amount of deposits in cash at all times, because essentially they wouldn't be able to lend money because if at any time someone wanted their money back, they would need that money to pay them back. But typically, if the inflows and outflows or withdrawals and deposits are equal, this will never really be a case, as long as the percentage of the withdrawals and deposits are a small fraction of the total cash reserves. And obviously, most people with loans and with deposits typically aren't withdrawing like their whole account within a day, or within a period of day. Typically, it's a small percentage, like your paycheck gets put into your bank account, and for most people, that's a small percentage of your total account value. And when you go to pay rent, you just pay rent with it, and that's a small percentage of your total account value. You don't have someone taking out their whole life savings from a checking account in one day. But if that were to happen broadly, you would have a run on just about every bank. So that's what more or less caused these precise banks to fall massively from large to small, and everything that had a connection to SFB was broadly disrupted. With the exception of today, the dollar has broadly been falling, and but despite this, equities have also broadly been falling. With a small relief rally 2 days ago, you saw one day ago, you saw more or less continuous downflows in the market and downflows in the dollar. Pretty unusual, but it could be explained by the massively rising yields that all of a sudden got reversed once the CPI came out. The CPI came out exactly on target, though. Like the year over year, the core year over year, the month, except for the core month over month, which came in at 0.5, whereas 0.4 was expected. But in general, the month over month seems to have the trend that inflation will continue to trend down, because if you annualize, either 0.5 or 0.4, which was the non-core year over year, you would see that, annualized 0.4, you're talking 4.8, where obviously right now the non-core is sitting at 6, which was a downtick from the previous month of 6.4. So, and that, the month over month hints that in the near future we'll continue at this down rate of inflation. So that gave the Fed a lot of breathing room. But one thing that caused a lot of panic and that now might completely disrupt the Fed's plan is this bankruptcy, or not current bankruptcy, they haven't declared bankruptcy yet, but all the assets have been seized by the Fed and the bank is completely underwater and has collapsed. But that of SFB, and obviously with Signature Bank, and the hint from the Fed that there's broad market risk within both these banks and the banking sector as a whole, this could cause, the Fed to pull off their interest rate hikes. Since they've hiked at such a fast rate, a lot of these institutions haven't been able to, adjust quick enough, and a lot of them, especially the more risk-on banks, have loaned out considerable amounts of money to ventures that were, more risk-on and more rate-sensitive in general, such as SFB. Obviously, the startup industry is a very risk-on business, with many going under, and with, while the capital came from venture capitalists, the amount, the withdrawal rate and the type of ventures that the bank was privately investing in was much more risky than most banks. And also, a big notable news story that I found kind of funny was the fact, not funny if you lost a bunch of money, but funny as in how could they possibly do this, was for the last 9 months leading up to this, you more or less had no risk manager at SFB. So how would you expect proper risk management if until it was January 2023 all the way until like early 2022, there was no risk manager at a bank after the last one left? It's the 16th largest bank at a time where interest rates were going through the roof, and obviously risk calculations needed to be completely different from the last 2 decades. Like, you had a complete 180 on what exactly needed to be done, and there was no one in the driver's seat to actually do what needed to be done. So it was, inevitable that something like this would have happened given that circumstance, and I don't know how people in upper management could have predicted anything else. Yesterday, we saw stocks broadly decline after the rally we saw on Monday. We saw them broadly decline yesterday due to the PPI coming out considerably. Today, the big data that we had that came out was retail sales that were expected to come out at negative 0.4 did indeed meet expectations and came out at negative 0.4. This is a big downtick from the previous month of January. Remember, they report every month the month after, that came out 3.2%. You definitely didn't expect that nominal amount to be spent on retail sales, given that consumers are generally running low on money, but that's exactly more or less what we saw there. And then as far as retail sales excluding autos, you saw that go down by negative 0.1%. And it was expected to be 0%, so even a smaller decline than was expected, and obviously still a lot down from the 2.4% that we saw last month. As far as the producer price index, this one we saw going way under expectation. The month over month came in at negative 0.1, where the expectation was 0.3, and the previous month was 0.3. So this definitely gave a lot of people a good sign that in the producer side, we're seeing even more, actually, given that's a negative number, genuine deflation within producer prices. Take in mind, the core PPI was still up, but still well below expectation. It came in at 0.2, where the expectation was 0.4, and the previous month was 0.5. The year-over-year PPI came in at 4.6, where the previous month was 5.7, and the core PPI year-over-year came in at 4.4, where the previous month was also 4.4. Some other notable data points that came out today was the Empire State Manufacturing Index came out for March, and it came out at negative 24.6, where it was expected to come out at negative 7.8, and the previous month was negative 5.8. Definitely showing a large decline in manufacturing within the Empire State, being New York. So much less manufacturing, and that will go more or less probably along with the next data point that we got, which is business inventories, which declined negative 0.1%, whereas expected to be 0.1%, as opposed to the following month, the previous month, that was 0.3%. And obviously, you've been seeing business inventories continue to climb rapidly over the last 6 months, and now we finally see a decline. And this could easily go in line with reduced manufacturing from the Empire State, and obviously from just about every state, in addition to the lack of imports and the lack of foreign trade that we've been seeing in the past few data points. The last piece of data that came out today, the only one that came out today that pointed anywhere towards inflationary, everything here came out as inflation is much less, or even, as far as the producer price index and a few others, mainly the producer price index month over month, was actually deflationary, was the Home Builders Survey. It still is, so remember, a 50 is a neutral, so it still came in below neutral, but it did beat expectations. It came in at 44, where it was predicted to come in at 40, and the previous month it was 42, showing a little bit more optimism within home builders. And once again, this is for March, and this could easily be reflected by the recent drop in interest rates that we've seen, in addition to more or less home buying not slowing down as much as a lot of people have predicted. We've seen slowing in lots of other industries, in addition to, just manufactured goods as wholes, autos, many other categories. But as far as the home builders are concerned, they still seem relatively optimistic, where obviously if you asked people a year ago what they were expecting from this industry, a lot of people were expecting this to go a lot worse for the home builders and for the real estate agent, like real estate industry as a whole. But despite that, it's continued to be, while going into more of a seller's or buyer's market from a hardcore seller's market, there still seems to be a fair amount of transactions to keep the market afloat. Take in mind, transactions nationally are still down 35% from the previous year, but obviously the previous year was a crazy anomaly where if you listed anything, it would almost guaranteed to be sold within a matter of, days to hours. Where now, obviously, it takes the typical, less than the typical amount of time, at least in my local area. But still, you're talking a couple weeks as opposed to the the most average time that we've seen over the last 3 decades, which is about 2 months. And this is mainly driven by the lack of inventory, which is why the home builders most likely still have this great optimism, is because they're essentially adding inventory to a market that has no inventory, where prices still haven't declined that much. But obviously, I think you could see this rapidly change once prices change a lot, or if interest rates go up a lot. But, given the inflationary data coming in rather weak and problems with the broader banking sector, I wouldn't expect that much more hiking from the Federal Reserve. So mortgage rates will probably kind of top out like max, worst case scenario, at like 9%, more realistically at like 8%, and will come down from that. Take in mind, right now the 30-year mortgage is more or less sitting at 6.6% with good credit, and obviously a little bit more the worse credit you have. But this could easily, and most likely will, go up in the next coming weeks to months, but probably won't go nearly as high as a lot of people predicted, and will breathe a lot of fresh air into the real estate industry. Some big things that we have happening tomorrow that we're going to be looking at is the initial joblessness claim. It's expected to come in at 205,000, as opposed to the last month, which was 211,000, which came in a little bit over expectation for the first time in a long time. These initial joblessness claims for the last 6 months previous to the last month have been coming in under expectation. And finally we got one to beat, showing that the job market is hopefully slowing faster than people, is slowing at a rate that's acceptable to the Fed. Slower than what they were hoping, but better late than never, that's for sure. As far as import price index, again, another decline predicted of 0.2%, and was the same as the last month of 0.2%. I would expect this one to come out about the same or even lower, which would obviously be good news. And two big things that I'm definitely looking at tomorrow is going to be the housing starts and the building permits. Housing starts are expected to be the exact same as the previous month at 1.31 million, and building permits are expected to be the same as the exact last month at 1.34, as opposed to the 1.34 in the previous month. These in particular I expect to give a lot more insight, because take in mind, we saw the home builder index come out today, and it came out a little bit, still negative because it was below 50, but a lot higher than a lot of people probably expected going into it. If anything, I think a lot of people are predicting it to be lower than expectations, but in fact it not only beat the previous month, but it came in over expectations. Still negative though. But given that, you might see these tick up a little bit, both in permits and in housing starts. And take in mind, permits tend to, delay housing starts. So you look at permits to more or less see what's going to be coming in the near future, and you look at housing starts to see what's happening right now. And still, with the permits being higher than the starts, you still see an expanding new construction business. This could be due to the interest rate subsidizing that a lot of companies are doing, in addition to other things such as just the lack of inventory in the market and buyers not having relative choice, especially at the higher end, causing them to want something, that's premium and might as well get it new, especially if you're planning to be there for a couple years. New construction generally isn't, almost never is a good flip, so you'd want to be there for a couple years. But if you find something that you're in love with, it's definitely could be a great property for you if you're planning to invest your roots in a community and be there for multiple years and obviously maintain the property. Going over the market performance today, we saw the Dow Jones go down negative 0.87%. We saw the S&P 500 go down approximately negative 0.5%, and the NASDAQ had a small rally of plus 0.01, 0.05 I meant. This was more or less supported by the end of the day rally that we saw. The beginning, the futures on the open were very rough. We saw almost all indexes down over 2% at the open and trended down further within the first 30 minutes. Throughout the rest of the day, it was more or less a continuous rebound across all indices. The Russell 2000, which is small cap stocks that we don't regularly talk about, was down over 3.2% at the low of the day. Definitely was a big decline. The dollar was up at the peak 1.25%, which was quite a rally in the dollar. We finally saw the Dixie go over the 105 threshold. That's, it's been trending down for the last little bit, but definitely quite a pop. As far as commodities, they generally trended down today. Bond yields went up. A big commodity outlier that we saw was oil. Oil went down almost to $65 a barrel, down over 7% at the peak. It only closed down at about $68 a barrel, and this resulted in RBOB, the gasoline that we buy in our cars, going down to a wholesale price of 2.30 on the low of the day, and then ended up closing at the end of the day went down to 2.40%, or slightly below that, but ended up closing the day at $2.45 a gallon. The 10-year ended the day at 3.45%. and the 2-year ended the day at 3.879%. Thanks for coming back here and watching another video. Once again, this is Financial Markets Languish with Blake. If you want to watch my previous video from yesterday, click over here. If you want to watch a YouTube short I made, click down here. And if you want some contact information to reach out to me about any kind of financial advice, any kind of personal advice, or if you want any real estate advice, I am a licensed real estate agent and can be a licensed fiduciary within the state of Florida, but I can also give you broad assistance and broad advice in any other state you live in. Feel free to click up here. Thank you very much for coming back and watching, and feel free to watch any of this additional content or reach out. And I hope you have a great rest of your day and are able to apply this information in your daily life or in your financial life. Thank you very much, and I hope to see you back here soon.